Federal Reserve. Stan is one of my personal favorites. There is so much we can learn from understanding how he sees the future, how he looks at markets, and what he's done in the past. We're going to start, step number one, with looking at his framework. He has the ultimate flexibility in his thinking. As an example of this, look at his political belief system. He's a big climate change guy. He's really a greenie by his own admission. So if I said that to you, you'd automatically put him into a category and think, well, if he thinks that, then he thinks this, this, and this. But you would be wrong. He's also a huge proponent of free market capitalism, a real Milton Friedman type of guy. But then he's also in favor of raising the capital gains. To take it a step further, he is pro-Brexit. All of these thoughts you would think couldn't coexist, but it's a great example of that flexible thinking. This dovetails into another one of his investment strengths that makes him incredibly unique, and this is his ability to change his mind instantly. As an example, going back to 1987, in Black Monday, when the stock market crashed by 22%, that Friday before, Stan Druckenmiller, his portfolio was 130% long. How can it be more than 100%? Because he was leveraged long. That Saturday, he talked to George Soros, who gave him a study from Paul Tudor Jones. And this study completely changed Druckenmiller's outlook for the markets. He went into the office before the market opened Monday morning, and he knew that he was wrong. As soon as the market opened up, he sold everything and flipped his position from 130% long to net short. To dive into this a little further, let's go to the Market Wizards book by Jack Schweiger in an actual interview where Druckenmiller explains this. The market opened over 200 points lower. And I know that doesn't sound like a lot, but that would have been a 10% drop. He goes on to say, I knew I had to get out. Fortunately, there was a brief bounce shortly after the opening, and I was able to sell my entire long position and actually go net short. It's a great story, but it not only shows Druckenmiller's ability to change his mind instantly, but it shows his ability to do so with conviction. Billions of dollars worth of conviction. Next, he has a complete removal of his personal bias. He could believe one thing and bet the opposite direction if he thinks he's going to make money. And I find it very interesting that a lot of great investors do the same thing. Jim Rogers, as an example, is hugely bearish long-term on the United States dollar. But the last time I saw a video with Rogers, he was long USD because he thinks in the short term it's going to be a flight to safety. So he hates the US dollar, but he's long short term because he thinks he's going to make money. Jim Grant, a real hard money Austrian type of guy. Back in the housing crisis, I remember he was on CNBC, and they asked him, Jim, would you buy mortgage-backed securities right now? Knowing that he's an Austrian and a hard money guy, you would assume that he would immediately say, absolutely not. And that's what the CNBC talking head thought he would say. But, curiously enough, the first thing Jim Grant said is, at what price? That is a smart investor. And I'm not going to throw myself in there in the mix at all, but you guys know what my long-term view of the U.S. economy is. But back in 2012, I went almost all in on real estate because I thought it was a good price. Now let's look at one of Druckenmiller's key strategies to timing the market. So many of us out there are hugely bearish on the market. We know it's in a bubble. We know it's at all-time highs. We know it's just pumped up with liquidity. So we're all expecting it to crash. But Druckenmiller, although long term, he totally agrees with us. He is actually long the market. Through his experience, he believes that you don't get a big recession or a crash unless you have tight monetary policy. So as long as the Fed is easing money and pumping liquidity into the system, he is going to have at least some long positions in the stock market. And I thought this was really interesting when I heard him say this. So I went back and pulled up a chart. Editor, let's throw up that chart right now. And if you look at the recessions going back 30 or 40 years, you'll see that almost every single time we go into a recession, it is preceded by the Federal Reserve tightening interest rates. Stan Druckenmiller is right on the money as usual. Some words of caution that I want to give you. A lot of people will look at that and say, well, if Stan Druckenmiller's long the market, then I should be long the market. Now, that's not the right way to look at it. The reason I say that is because Druckenmiller is an extremely active investor. Usually his time horizon is maybe 3 weeks to 3 months. So the normal investor that comes in here and says, well, I'm just going to throw my money in an ETF or an index of the S&P and just go back to my porch and sip lemonade, just set it and forget it, you're going to be in big, big trouble because Stan can flip on a dime and change his position just like he did in 1987. Step number 2, what does Stanley Druckenmiller think about inflation? And to analyze this, we need to look at his portfolio, not just what he says, just like we did with Warren Buffett the other day. So I'm taking this information from a Bloomberg interview that Druckenmiller did just a couple days ago. First, he is long U.S. stocks, but keep in mind, he's a short, long hedge fund guy. So just because he's long, that means that he's net long. It doesn't mean that 100% of his positions are on the long side. So if he's 60-40, anything above 50%, and Stan would say that he's long stocks. And also remember that he is very bearish long term, and he's a short term horizon type of trader. So he's in and out of things in weeks or months. So this isn't like your buddy who's got 100 shares of Apple in a Robinhood account. Nothing like that at all. Number 2, short fixed income, especially on the long end of the yield curve. And this is in the US. So he's short 10-year treasuries and 30-year treasuries. He's long commodities and the commodity producing currencies, more specifically the Canadian dollar and the Aussie dollar. And I'd just like to point out that the COP is a commodity currency as well. And most of you know from watching my videos, I've got a lot of investments in Colombia. He's short yen, which is an importer of commodities, and he's long British financials. So looking at this portfolio, what can we conclude? Well, first and foremost, it goes back to his position on liquidity. He knows that even if he's bearish long-term on the market, if the Fed is pumping all of this liquidity into the system, if they're going to do QE4, if they're going into the repo market, if they're dropping interest rates, that means there's tons of cash going into the market, and Stan wants to ride that wave of cash. Next, he's got the short fixed income play and the long commodities, short yen. That means he sees inflation on the horizon. Why? Inflation will drive commodity prices higher. That will drive down the prices of bonds and treasuries. And the yen will most likely go down because Japan has to import all of those commodities that are increasing in price. That's harder on their economy, therefore short the yen. And he's long UK financials. Got a little yield curve, 3-month, 1-year, 10-year, 30-year. Right now, it's relatively flat. There's a little bit of a slope to it, but not much. Stan sees inflation hitting the United States and most developed countries. So that would mean the yield curve is going to steepen. The interest rates are going to increase. That's going to decrease the price of bonds because there's an inverse relationship between the two, but it's going to make the banks more profitable, theoretically, because they make their money on borrowing short and lending long, collecting the spread. So if there's a bigger spread to the yield curve, that is bullish for financials. So with this play, he's betting on Brexit, that's going to be good for the British economy, and going back to his inflation bet. Step number 3, what does Stanley Druckenmiller think of the Federal Reserve? Let's check out a clip of his most recent Bloomberg interview because he gives us some brilliant insights. This is amazing. Check this out.
I think it's always easy to be easing and things are great and you just feel like you're the cat's meow. You'll remember Bernanke claiming victory in 2004 with the great moderation, and Greenspan was a maestro. But I will go to my grave believing that financial crisis happened because of bubbles created by easy money. And I just don't understand why we need interest rates where they are now. We normalize, we're trying to normalize, okay, things got too tight, should back off, but you don't need to go the other way to the extent we've had. And then this crazy president saying we need negative rates to compete with negative rates in countries where they clearly aren't working. They're not growing as well as I do. It's the most anti-capitalist idea I could ever dream up. And
exactly.
He's pushing Powell. And, I didn't want to believe this, but it's pretty clear now that he's had an effect on Powell. And, of course, the media is going, oh, he's really standing up to him. Well, with verbiage, not in action. In action, he's been cutting and doing the president's bidding.
He hasn't gone negative.
God help us.
Just brilliant words there. The main takeaway is, like all of us, he believes that the Fed is at the heart of creating these bubbles, not just the dot-com bubble, but the housing bubble and now the current bubble that we're in. And you can see what he thinks of negative interest rates.
Some people say he deserved high marks, whether it's the media or others deserve high marks for resisting some of that pressure from the White House. What kind of grade would you give Jay Powell as Fed chairman?
Not a good one. Let's not compare him with my true hero, Paul Volcker, who...
The late, great Paul Volcker.
Yes, who he cited his courage, and I couldn't agree more, and it's too bad we don't have some of that kind of courage at the Fed today.
When he refers to courage, he's talking about how Volcker jacked interest rates up to 20%, the Fed funds rate, to crush inflation. He knew it was going to bring on a really bad recession, and he did it anyway. That's the courage that Druckenmiller is talking about.
Central bankers, whether it's policymakers at the ECB or, for that matter, members of the FOMC, seem determined at whatever cost to bring inflation back to 2%. In Europe, it's meant negative rates. Here, they're now beginning to talk about inflation averaging, be a catch-up period if it hasn't met the 2% target for a period of time. My question to you isn't whether negative rates necessarily work or whether averaging inflation is necessarily a good idea. You're free to answer both. But first, I want to know whether you think inflation matters anymore.
Well, first of all, there's 14 recognized measures of inflation. 12 of them are above 2%. Their preferred measure, the core PCE, is at 1.7%. The risks they are taking with regard to misallocation of resources, bubbles, all that stuff, because something is at 1.7 as opposed to 2, and now they're talking about a makeup period. First of all, monetary policy is supposed to look forward, not backward. So why are we looking backward? And if there's a makeup period, after inflation was 10% in the 70s, why didn't we have a target of minus 10 a year in the 80s.
That is awesome. And that's such a great point. I love that. I love it. If inflation was at 10% or 12% in the 70s, why didn't we want negative 10% inflation in the 80s? That is such a great point.
Talking about decimal points here, about something, Eric, that you can't even really measure. So, and I'd like to remind everyone, because now they've turned it into a mandate. There is no mandate for 2%. The mandate states very clearly price stability and full employment.
In this country, yes.
Well, I live in this country, and so does the Fed. And I don't know how 1.7% is not like the greatest success ever if we're talking about price stability.
What he's saying there is they're taking a tremendous amount of downside risk in the misallocation of resources. And we're going to talk about that on the whiteboard momentarily. They're taking all that risk just to try to get inflation from 1.7 to 2. And to his point, is it really that big of a deal when the gauge that they use for inflation is incredibly inaccurate?
So this thing about it's the greatest challenge of our time to get it from 1.7 to 2, well, we don't even know whether it's 1 or 3. It's just, the measurements are so random. I just find it astonishing.
We're living in a time of technological advancement, all kinds of new innovations that are creating deflationary pressures, surely reflected in that 1.7, whether you think it's adequately or accurately measured. Where does that fit into your thinking about the importance of inflation at all?
I'm glad you asked, because in the last big...
This is a key point, guys, so make sure you're paying attention to this. And a lot of the most recent videos, I'm talking about how the Fed is just addicted to not only inflation, but they're addicted to that inflation because they think that it will increase spending. And Druckenmiller debunks that thoroughly right now.
Technological revolution was the late 1800s, and we had 3% deflation and 8% real growth for 10 years. So I remember talking to a central banker. So medical is 19% of GDP here. What if you found a way, either through co-payments or whatever, to get the consumer to respond to price, and then you used our technological wonder kinds, let's just call it for no better term, what if we Amazoned the whole medical system and you drove the cost of of healthcare down in this country from, say, 19 to 13? It's 11 in most other countries. Would the Fed then panic because it sends the CPI under 0? Is this some horrible thing?
Exactly.
That it's going to be the greatest crisis of our time and have a huge response to? No. And I would say the same thing about all this stuff writ large. You have these magnificent productivity increases going on right now at the corporate level because of cloud content and so forth. There's nothing pernicious about deflation if it's driven from the supply side. I don't see people walking around, oh my God, I'm not going to buy a car this month because it might be cheaper in 3 months. And by the way, we haven't even had deflation. It's just sort of this imaginary thing that it's not up to their 2% arbitrary target.
That was awesome, wasn't it? I probably watched that video about 10 times. I would suggest doing the same thing. We'll put a link in the description below. There's 2 main takeaways from that video, although everything was awesome. First, misallocation of resources. This is such an important topic. It really deserves its own video, but we'll just touch on the highlights right now. And what I'm going to share with you right now, I can almost promise you that you've never heard of before. You probably never thought through. So really focus on this one, guys. We've got limited resources with alternative uses. We know that is the basics, the foundation of economic study. Examples would be time, materials, and capital. You can only have 2 outcomes with the allocation of these resources: a positive and a negative, and a negative and a negative. You cannot have a positive and a positive. And you may be saying to yourself, George, what? What are you talking about? That doesn't make any sense. Let me explain. Your time. Let's say you work 8 hours today. Well, that's a positive because you need that money to provide for yourself or your family. But there's a negative because you're taking that time from doing something else, such as hanging out with your family or maybe going to your kid's football game. And it can be a negative and a negative. As an example of that, let's use materials. Let's say we've got a bunch of steel. Well, that steel could go to building a building. But instead, the government can take that steel and use it to fight a war, to build machines to fight a war. You've got a negative in the sense that they're taking that away from a productive asset. They're taking those resources away from something that would have made the economy better. That is a negative. And they're using it to fight a war and kill people. That is also a negative. So then you might say, well, George, can't we have a positive and a positive? No, we can't. Because in order to take a limited resource and use it for something, XYZ, we have to take it away from ABC. And that's hugely important that you understand that. Because when the government, or when we make decisions in our own lives, we have to look at things from a standpoint of a cost-benefit analysis. And so many of us only look at the costs of doing something, or we only look at the benefits of doing something, and we don't look at things on net balance. Let's use the government as an example in their war on drugs. Well, they just look at the positive. Well, that creates fewer people using drugs. Well, it may or may not, but they don't look at the costs. And if you look at the costs of waging that war, you'll see that they far, far outweigh any of the positive effects. Next is deflation, which Druckenmiller points out correctly isn't always bad. The Fed believes that if prices go down, spending will freeze. No one will spend $1 because they'll think that what they're trying to buy today or what they need to buy today, they'll be able to buy tomorrow or next week at a cheaper price. This is complete nonsense. First and foremost, credit cards. What is a credit card? It's basically giving you the option to buy something today at a more expensive price because you're adding the interest, then buy it in a week or a year at a cheaper price when you wouldn't have that interest. Food and gas. Have you ever gone to the gas station and said, nah, I'm going to skip it today because I think gas will be cheaper tomorrow? How about food? You're really, really super hungry, but you're like, nah, I don't think so. I'm going to go ahead and hold off a week and just maybe absorb some sun rays because I think that I can get that burrito for 6 cents less next Thursday. How about a new car? Why would anyone buy a new car if they're that price sensitive? They'd just buy a used car. Or technology. Why are people lining up to buy a piece of tech like a TV or a cell phone when they could get that same TV in 2 years for half the price? It doesn't make any sense at all. This goes right back to the Federal Reserve misallocating resources because they're trying to fight this boogeyman that doesn't exist. What we can really learn from Druckenmiller's thinking is you've got to keep an open mind. You've got to be nimble and flexible when you look at your investments. You can't be too rigid. The way Druckenmiller predicts market downturns is through the tightening of liquidity. And we know he thinks we're going to get some inflation very soon. And lastly, he has an opinion that we can all agree on, and that is that the Fed sucks. We had several people donate to the channel this week. I really sincerely appreciate it. I'd like to personally thank Nolan Larson, John Jenkins, Jeff MacArthur, Byron Flores, McDonald Halley, Stacy, Tyler, Quantum Frosh Web Services, Business and Real Estate Law Group, and Total Media Inc. For any of you who would like to support the channel via PayPal, we'll put a link in the description below, and you can always go to the About Us section on the homepage of this channel. For more information like this, check out this content right here, and I will see you on the next video.